You've probably seen videos claiming you can value a stock in 2 minutes. I don't think that's possible. I really don't. Hi, investors. You're watching Victor Value. In just about 2 minutes, you can decide something important. You can decide whether a stock is worth studying or whether it should be ignored completely. This video is not a valuation. Let me say that again. This is a filter. Most investors don't lose money because their Excel model is wrong. They lose money because they spend time on the wrong companies. I made that mistake myself, more than once. I spent weeks modeling businesses that were never investable to begin with. Time is capital, and deep value investing is mostly about not wasting it. The first question I ask is very simple. Do I understand how this business actually makes money? Not the story, not the narrative, the economics. Who pays? Why do they pay? And what would make them stop paying? Sometimes the answer looks obvious, but when you slow down, it's actually not. If I can't explain the business in one short sentence, I usually stop right there. Let me give you a quick example. A few years ago, I found a stock that looked extremely cheap. Low multiples, nice growth on paper. Everything looked fine. So I started building a full model, revenue forecasts, discount rates, the whole thing. Only later did I realize something basic. I didn't really understand why customers were paying in the first place. The business was cheap for a reason. That mistake cost me time, not money. But time is already expensive enough. Since then, I screen first and analyze later. Second filter is cash. After the business, I look at survival. Is the company producing cash or burning it? And more important, can it survive without raising money? A lot of companies look cheap because the market already expects dilution. A stock can look cheap and still destroy value through dilution. Value is not about cheap prices. It's about survivable businesses. Now, a lot of fast valuation content focuses on metrics, especially ratios like PEG or PEGY. And yes, I do look at PEGY sometimes, but only as a rough filter. Never as a valuation. A low PEG can still hide bad incentives, weak governance, or structural decline. Metrics don't replace thinking, they only support it. Third filter is risk. Before thinking about upside, I ask one uncomfortable question. What can permanently break this business? Debt, regulation, technology, industry decline. Not temporary problems. Permanent ones. If I can't clearly see the downside, I don't go further. This process does not tell me what the stock is worth. It does not give me a buy signal. It answers only one question. Is this worth deeper work, yes or no? Fast valuation feels productive. I get why it's popular. But skipping business, quality, and risk is not speed. It's just skipping thinking. 2 minutes should eliminate ideas, not justify them. This is how I start every deep value idea. Slow, selective, risk first. If you made it this far, I'm curious. What's the first thing you look at when a stock looks cheap? You can leave a comment below. No right answer, just how you think. That's it for me. No hype, no promises, just long-term thinking. Thanks for watching.